talking about tech, but I'm going to keep talking about tech, but I'm going to try and keep it light and not too technical. So it's always good to start off with a bit of a cartoon. This one this is the happy family back in Roman times saying, hey, would you mind taking a quick sculpture of me and my family? So clearly, technology has improved our productivity, made things happen a bit faster. My 16-year-old daughter was like, OMG, is that really how they did it back then? No. Oh, wrong way. But clearly, technology can also be a huge distraction. I really like this one from the New Yorker, which is this collar keeps me from looking at my phone every 2 seconds, right? So distraction is a major issue. But nevertheless, let's talk. Awesome. Does that come through? Yeah. Well, let's just talk about my history a little bit, because I started a fintech kind of 20 years ago without even realizing it was a fintech. Of course, no one used that term. But what we were trying to do, and what I was trying to do, is create, at that point, it was an information service providing sort of uniform, broad-based equity information and later equity research. I guess that in itself wasn't that different, although putting it online at the time was a bit unique. But the thing, I guess, that was interesting about it ultimately was that it was for self-directed investors, and it was unbundled from broking. So back then, if you wanted to get a research report on a company, you really could only get it by going to a broker, and you can only go to a full-service broker. And so it came with a whole bunch of other stuff which you may or may not want. So the thing that was different was really the unbundling more than anything, and to a lesser extent, the delivery mechanism of the internet. So that business did okay. In the end, we merged it with another business called Huntley's, which was actually kind of a long-standing newsletter publisher. It had been in the market for a long time at that point. That really bulked us up and gave us a bunch of better capabilities. We sold that business to Morningstar in 2006. And really what we built became kind of the equities piece of Morningstar. And so many of you are probably familiar with the research reports and all the equity data and information they provide. That's basically came from that platform we built. I ran the Morningstar business till 2010 here, and then sort of said, well, you know, really building businesses is more fun than, you know, reporting into headquarters in Chicago. So I decided to, at that point, become a full-time angel investor. I say angel in brackets because the angel bit is really about investing in early stage businesses, trying to work with new companies and get them moving forward. Really, most of my time is actually just investing a portfolio, which we have. The angel bit, it's probably about 25% of the overall portfolio. I'd like to make it more, but my wife, who's also on the investment committee, keeps limiting my asset allocation, so I have to keep it within limits. Here's a couple of artifacts. This is the first, we published this book around 2000. This is in 2000. We were hedging our bets as to whether the internet would be a lasting thing, so we published a book as well as had an online website. But funnily enough, the website, I couldn't find any trace of it anymore. The only thing I can find from that period is the book. So I don't know what that says about longevity. But this was an early co-branded book we did with 9MSN. We gave them all the data to run their finance portal. I'll bet you didn't know that 9MSN was actually a book publisher for a while. So it shows you that you kind of had to like try different things. That wasn't the bestseller, I got to say, but you know, we got a good deal with 9MSN, which then introduced us to CompSec, which then introduced us to virtually every other broker in the market. So that book actually made us a lot of money in the end. It was good. This is one of our early tear sheets from that period. This is one tell. I'm not sure if you can read that. Another early high flyer. What could go wrong? So, you know, they don't always go one direction. So what have I invested in so far? And this is over the course of the last few years. Well, you know, it's across the board. It tends to be mostly SaaS, cloud-based businesses. My main sort of stake in this area is ShareSite, which you've heard about a little bit before. But I've invested LegalVision. We were the first investors there, which is Some of you may have come across that. It's going gangbusters. It's essentially an online law firm. Alert Systems, which is a sort of a SaaS content management play for big organizations, which is kind of behind the scenes. You probably haven't heard of that. Timebase is an online legal information portal. Shoebox is an add-on to Xero and other accounting systems. Critical Arc is a cool like web-based app for university perimeter management and all sorts of cool stuff. Emborder is about onboarding HR, and it's an HR app onboarding new employees, etc. And then Xero, which I'm cheating with a little bit because I did invest in them after they had already listed. And actually, one of my takeaways that I'd leave with you is that for most people, if you're interested in fintech, start with what's listed because there's a lot more information about it, and it's an easier way to get started. The price may be a bit higher, particularly some of the fintechs, listed fintechs in this room. But at least you have a better idea of what you're getting into. But Xero is interesting because I first came across them. They were selling at $1.50 at the time. They were listed, and I thought, geez, that's way too expensive. So I let it pass, and then rocketed within the next 18 months, I think, up to $40. So that was a bit of a fail. But then I realized it was too expensive. It came back down to 11. That's when I bought it. And I think I made 3 times my money on Xero since I first invested. So it does show you that often you get more than one chance to have a go at these things. And in fact, Xero, I would argue, was far less risky and actually a cheaper investment at the entry point that I came in rather than the original 150, although, of course, the 150 would have been nice. So what do I look for? And really, I think it's a very personal thing being an investor in this space. And I don't think you should shy away from that. I think you really have to embrace it. So, I mean, this is a quote that I liked from the founder of Y Combinator, who said, the very best startup ideas are when you start looking for, you don't want to think about an idea. What you want to do is look for problems that you can solve. And ideally, it's problems you've experienced yourself. So that degree of you understanding the problem and being able to internalize it is really critical in assessing whether this idea, this company that gets presented to you has any merit. Because without knowing the space yourself or having experienced the problem, it's really very hard to form a judgment. He goes on to say there's sort of 3 things. One is that it's a solution that founders themselves want. It's something they can build, and something that few realize that are worth doing. In retrospect, and I love, you can look backwards in hindsight and say, oh, look, I tick all those boxes when I started my company. I wasn't quite that strategic at the time, but in retrospect, I do think those 3 things are what made it work. And I'll explain a bit more about what those means in a practical sense. But if you really look at successful startups and you go back at their history, almost invariably you'll find that they do tick these 3 boxes. So the other thing is, to be successful, you have to, or to win big, you have to be contrarian and you have to be right, which putting the 2 together is kind of the hard part. You can be one or the other. And here's my sort of consultant 2x2 matrix just to explain about it a bit. So let's say you can be right, but it's a momentum play. In other words, everybody knows about it and you're kind of jumping on the bandwagon. I would characterize, let's say, Google now, or a lot of these FANG stocks, as being in that category. I mean, that's not to say they're going to make more money. I think they probably will. But you're paying certainly a pretty decent price to join the party. I would even say a lot of the recent listings, NetWealth and some of the other ones, I think they're great companies, will continue to do well. But your entry point now is obviously, they've been discovered. The entry point's not cheap, to say the least. So that's one way to make money, but you're not going to win big. Momentum and wrong, well, the analogy there would be, your active index hugger, right? So who is able to say to his boss, well, yes, I lost money in absolute terms, but I lost less than the guy next to me, right? So that's momentum and wrong. I put Bitcoin in that category, and I'd love to have some debate on whether Bitcoin is a bubble, its future, or whatever. Personally, I'm in the bubble, and I think blockchain's really interesting. Bitcoin, not so much. But to be contrarian is, so, you got to be right and contrarian. So Google in 1999, of course, Google is now, it's obvious, it's huge, it's dominant. But in 1999, search was done, right? Yahoo was out, it was dominant, and this new thing came along. Well, why would anybody invest in search? So that's the key. You've got to have something where you know you're right or you're confident you're right, but everyone else thinks you're wrong. And of course, being contrarian and wrong, that's the worst. Most people don't even know because the bodies never get found. That's actually most people, but that's not the ones you hear about. I guess the other thing too is risk management, right? So if you're going to embrace risk, you got to manage it actively. This is another cartoon. I like being a boatie and a bit of a DIY guy. This guy's just painted on his transom, my first boat. Of course, it's upside down. You're going to make mistakes, so you're going to have to understand how that works. So how do you manage risk? Well, like drinking, angel investing is best not done alone. What do I mean by that? It's very easy. As an angel investor, usually, I'm probably a fairly typical profile. I had a business, I sold it, I got a bit of cash, and I think I'm smart, I know I can pick good businesses. That's a very, very bad way to invest because you tend to go too quickly. You get caught up in your own bullshit, and it's easy to make mistakes. And I can say, actually, the first two investments that I made as an angel are my worst investments because I went too quickly. I did it alone, basically. And when you're saying don't do it alone, I've kind of made a rule for myself that I'll come up with ideas. I'll be the lead investor, let's say. But unless I can convince another investor to come along with me who's maybe not so close, then maybe that means that my brilliant idea as an investor is not quite as brilliant as I think it is. So get other people involved. The other thing I would say, and this is certainly can't be overestimated, if you're not embarrassed, and this is not I didn't come up with this, I think it was the founder of LinkedIn, but he said, if you're not embarrassed with version 1, then you've waited too long to launch. Right? You got to get version 1 out there. You got to push the entrepreneur to do it. Often they'll want to make it perfect, and they'll sit back. You got to push them to launch and use that process to refine and make it better. And I'll give the example, actually, of ShareSite, which has mostly got Australian clients, but has launched a Canadian version and UK version, and they launched it over a year and a bit ago. It was pretty bare bones, but we thought, well, look, let's just see, are there competitors in Canada? What's the product? What's the market like? The best way to find out these things is just to stick it out there, right? So they launched this product. It didn't get a lot of users, didn't get a lot of conversions or whatever, but you got some users and some conversions, and it started growing, and you'd get feedback saying, hey, look, pretty good, first effort, but you need to do A, B, and C. So that process, which was uncomfortable, really sped up the development of the Canadian version. And now, in the last few weeks, we've had more Canadian sign-ups at ShareSite than Australian sign-ups. So it's really, it would have taken a lot more money and a lot more time if it had been done any other way. The other thing is, I guess, is once you figure out what's working, double down. The other common mistake that angel investors make, and I've been guilty of this to a certain extent, is you get excited, you go out and you invest, small amounts in lots of companies, and of course, 60% of them will not do well or fail. You got 2 or 3 that are really looking promising, and you got no money left in your pocket to follow on, right? So you have to be very disciplined about putting in, you're really buying options rather than buying shares into future opportunities, and then when you see something that's working, then you can concentrate on the ones that are working, and those are the ones that are going to make your money and give you overall a respectable return. So, I guess from my point of view, I've internalized that, but it's also, I suppose, a bit more practical and visceral. So my goal number 1 is I don't want to have to get a real job again, right? So I need to make enough money and not lose enough money so that I don't have to go get a day job, which is the other one is I need to stay married. My wife's on the investment committees. I've said she doesn't really take any interest, but she's still got a day job, and when she tells me she wants to be done with that job, I need to be in a position where it's like, okay, fine. We don't need that job anymore. And the third one is I need to make a return, and this is benchmarking is important. Benchmarking is important in your kind of client portfolios, but it's important in this kind of portfolio, which is I need to benchmark my own returns so that I'm making as much as if I had had a real job and had handed, say, the portfolio over to a wealth manager or somebody else to manage, and then I just focused on the day job. So far, that seems to be working, but time will tell. Now, the other thing I'd say, and maybe this is a bit controversial, but I would say both as an investor and as an entrepreneur, avoid corporate venture capital wherever possible. This cartoon, I'm not sure you can see it, but it says, you all know General Peterson from IT. All these generals here are about age 60, and General Peterson is age 14. So, like, big corporates need the skill set of innovation, et cetera. They're interested, but more often than not, there's such a disconnect in terms of how the two parties are working together that I actually think in practice it's pretty hard to pull off. I could go on and on about what are those specific things. Probably the biggest one, though, is that as the entrepreneur, the investor, this company is your world. It's everything. For the corporate, more often than not, it's usually there'll be one person that you connect with. It's their sort of pet project. They're super keen. They're supportive. But hey, guess what? They get transferred somewhere else. They leave the company. And all of a sudden, you rock up, and nobody knows who you are. Nobody cares. And your great idea is a rounding error in their kind of P&L for the next year. It can be very dispiriting. I guess let's focus specifically on InvestTech or Wealth Tech, which is kind of the area that I'm most interested in the fintech space. And I very much started from the investor point of view or the customer point of view. I've got this book. Has anybody know this book? Where Are the Customer's Yachts? This book was written in 1940. It's about Wall Street. I swear to God, if you read this book, you'll be amazed how relevant financial markets are to 2017 to 1940. The principles are the same. The issues are the same. The joke in this comes from the fact, actually dates back to the 1870s when someone went along with J.P. Morgan, I think it was, to check out his mansion in Newport and his yacht, and he was looking at all the yachts in the harbor, all belonging to brokers and bankers, and he said, well, where are the customers' yachts? So the issue is like, who's making the money, right, out of all this transaction and investing? So that's got to be principle number one, and I think successful fintechs have to be able to address the question of where are the customers' yachts and increase the probability that the customer is going to get a yacht as well as the manager. So focus on self-directed investors. That's kind of my thing, I guess. Now, mind you, my definition of self-directed investors is pretty broad. To me, it's everybody who's not in defined benefit, right? If you're in defined benefit, and there are not many left, who are like, great, my retirement is your problem to solve. You have to give me an income stream. Everybody else, whether you use a wealth manager, an advisor, you do it yourself, the end result is your problem. So, one of the things that I feel that most investors, whether they're advised or not, it doesn't really matter, but I think they do themselves a disservice by not realizing that ultimately, no matter how much they delegate, it's still their problem, and the outcome is their problem. Which is why I'm interested, and one of the things that really attracted me to ShareSite in the early days is that hobbyist investors are the ones that I look at, because to me, in a way, they're the future, they're the early adopters. The hobbyist investor is the guy who actually enjoys like tinkering around with the portfolio. He gets online, he's got his accounting solution, he's signed up for ShareSite, he's bringing in the fees. And the fact that the reason why they're great is because A, they tend to be pretty smart and sophisticated. They're prepared to try things that are maybe 80% finished, not 100% finished, if it's sort of delivering on some fundamental benefits. So they're a fantastic crowd to get into. And generally speaking, if you iron out the bugs with them, then gradually you can start broadening your user base to not just be like the investment nerds, but the broader group of investors out there. So it's coming from it's not really the bottom, because often they're quite high net worth. It's more just a psychographic profile of someone who wants to sort of get in there. Now, I tend to meet that description. I'm an investment nerd, so I suppose that's why I kind of resonated. But for me, I understand it because I get the problem, I get the solution, and I can evaluate it in that context. So what are the things that I'm kind of interested in? Again, this is a very kind of personal list. Doesn't necessarily mean it's the only issues out there. But what I'm interested in is, obviously, when we talked quite a bit about it today, this concept of unbundled, connected, best-of-breed solutions. ShareSite clearly is sort of one of those. The idea of the virtual wrap, which I think sort of ShareSite represents, but it's not the only one. There are others. I mean, to me, I think it really has interesting potential to both reduce costs to the investor, but to give a better user outcome, better experience, and more control, which, as a self-directed investor, the growth of SMSFs being a testament to it, people want control, or a lot of people do. The other thing I'm interested, personal budgeting, savings, that kind of sort of boring basic stuff, and I was interested to hear Matt from NetWealth talk about that. I totally agree that is totally in the Stone Ages as far as how it works. And really, the essence of financial planning and personal finance and getting it right is step one, right? What's your income? What's your expenses? What's the budget? People don't know, they avoid it, and unless you do that process and you do it easily, I think for most people it's hard to move on to the next step. And the good advisors that I know spend a lot of time trying to coach people along that process. One of the biggest things for me is when I left Morningstar and I sort of had, I didn't have any investments at that point, or angel investments, wide open. What am I going to do? I started using Xero for myself, and I basically put all our personal finances, income, expenses, everything through Xero as using their business ledger, which, I wouldn't necessarily recommend it if you're not a hardcore investment geek. But actually, it wasn't that hard because Xero is so user-friendly, data feeds, bank feeds, whatever. And I can't tell you how much value I've gotten out of that process. And someone would look at that and say, well, why are you spending all the time like reconciling bank accounts? That's crazy. But once it's set up, it actually doesn't take much time. And every month, every quarter, I get insight into what's going on with our finances. And to be honest, I couldn't afford to sort of do this crazy angel thing unless I had like a really tight view of, like how much do we need to live on? What are our investment returns? Does A minus B still leave something? Those basic things are, I don't care whether you're starting out, you're a millennial, or you've actually got a large portfolio, or a reasonably large portfolio like us. So important. And so the opportunity here is you just got to make it easier. I think it's a screaming opportunity for banks because they've got all the data, but they're not really doing anything with it. I mean, Xero and those kind of tools are great, but I think they're probably, a bit too high-end for most people. Fund managers going direct, I think this is really interesting. By direct, I mean the proliferation of things that are being listed on the exchange. Both in terms of passive stuff, M funds, but ETMFs, you're seeing that. I guess that's a response to people, managers wanting to reach investors directly. And, oh, by the way, the ASX actually is a pretty good platform. And it's an open platform in the sense that people like ShareSite and others can easily tap into it, get data, custody, et cetera. So that to me is interesting, and I think that's still very early days and has got a lot more to run and has big implications, particularly for traditional platforms. All the boring stuff, I think, is really great, really interesting. Registries, custody. I hate custody. It's like, if I want to go get my car serviced, I'd have to sell the car to the car dealer so that he could service my car. If I want to buy a car, I can only buy the car if it comes with a chauffeur. I could go on with the analogies. it doesn't make any sense to me. And I know why it happens, and I know why you need it for master trusts and wraps or whatever. But hey, if you're using the ASX as your custody, then all of a sudden things start to simplify, and then there's different ways of recombining the bundle. Same thing with passive investing in ETFs, which I think, again, super interesting to me, and not really the whole passive versus active debate. I think there's room for both. Interestingly enough, as an investor, like at one end, I'm super active, right? Because I'm investing in these startups and getting involved in companies at a really minute level. I own a lot of ETFs. More than half of my portfolio is passive ETFs. Because you know what? I've only got a certain amount of investment bandwidth. I'm quite happy to say, I want US S&P 500 exposure. Just buy the ETF. I don't need to, active manager for every single little sub-asset class. And, I say this having run Morningstar. We're in the business of, evaluating these guys. And I do have active managers as well as passive. But they're such a great solution for portfolio construction. But the other thing I'd say about it, not just because of the passive thing, if you accept that ETFs are part of the portfolio, that piece, again, super simple to run. Much easier to do it yourself. Much easier to sort of tick off that asset class, this asset class, that one, and say, okay, emerging markets, whatever, done. So again, still early days, but has a lot of big longer-term implications. So what doesn't interest me? Anything the banks are doing, I'm finding hard to get excited about, sorry to say. And that's not to say that banks aren't doing a lot with technology. They are, but they're primarily doing things to improve the efficiency of their existing business. And I think that's very important. As a bank share investor, I applaud you and think you should do more of it. But going back to the corporate VC thing, I don't think that that sort of corporate innovation at the partnering stage is really, actually, I think the best way banks can engage with early stage is really to be a good acquirer and a good user of the services. So they can be a customer, but get really good at acquiring fintechs, because I can guarantee you most of them are going to fail, but there'll be some ones that are going to fail that actually are quite interesting ideas that in your environment actually might be able to succeed. So be a good acquirer, which is learn how to buy them quickly, have a team around onboarding them, figure out how to keep the IP without losing all the people, all that sort of stuff. So, but it's a different mindset than like a reinventure, just to pick on one, where it's like, hey, we're going to co-invest with a startup. And I know Simon quite well. I still don't think it's going to work. And I've had lots of companies I'm involved with where you talk to the big corporate and they say, oh, we're interested in using your product, but hey, we'd also like to get an equity stake in your business. And to me, that's a huge red flag, even though it's kind of flattering that they're interested, but it's rare that it works. Robo-advice, not interested. As an investor, I just don't think they're going to be making money, because I think robo-advice fundamentally is a distribution platform for ETFs. So, I think it was interesting. StockSpot, I think, has raised money from ETF securities. I think that makes total sense for ETF securities. But, I think it's going to be hard. And I think, while they've attracted a lot of attention in the US, robo really hasn't attracted much in the way of assets. Certainly the early guys like Wealthfront spent huge money from gullible angel investors and Silicon Valley investors, but they haven't actually delivered much. I think the ETF companies like Vanguard and BlackRock, et cetera, are going to clean up big time in that space. Cryptocurrencies, not interested. I do like blockchain. The one thing I'd say about Bitcoin, I saw in the news 2 days ago that Venezuela is going to launch its own cryptocurrency as a solution for its monetary woes. I think that's all you need to know about crypto. Peer-to-peer lending, non-bank lending, not interested. Again, not because I don't think it's an interesting idea, but I think banks have way more room to move on margin and to, if one thing that banks do well, it's lend money and take money. So, I'm dubious. Most payment technologies, not interested. NPP, which is coming soon, this new real-time payments platform. Super interesting, I think, because what it has the potential to do is really weaken the sort of the switching costs for investors, for bank account holders, because it's going to be much easier to switch. Running out of time. Data and privacy is going to be huge. I love this cartoon. The guy with the weird skin disease forgot to sign the privacy forms. So this is at the doctor's office, I guess. Privacy, I think everyone talks about it, and there's lots of forms to fill, but really what does it mean? And people becoming more conscious of what they're giving away to the Facebooks of the world. Regulation, no question, but how corporates deal with it responsibly is going to be huge. Questions? Oh yeah, last thing. Cartoons. As a content provider, I'm conscious that we got to protect people's IP. So you'll be glad to know that all those cartoons were appropriately licensed from Condé Nast. $10 a cartoon. It was actually really easy to do, which shows you that illegal download. This is a lesson for my teenage kids, but if you make content licensing cheap and easy, people will pay money rather than just stealing it. So that's good. Anyway, thank you very much.
Thank you, Andrew. Okay. We'll take some questions. Okay. That was fantastic. And I noticed when you showed this slide what I'm interested in,
yeah,
I saw everybody starting to
good.
write down. Look, I know it's the end of the day. Does anybody have any questions for Andrew? I think it was a really nice way to finish off the afternoon. It's got us all re-energized. I think in given time, I think it's time for Toby to come up and give a closing remarks for the day.
Right.
Thank you very much.